Here's a question that keeps economists up at night. Who ends up richer? The guy who can calculate compound interest in his sleep? The one who reads SEC filings for fun? Or the guy who thinks a bull market has something to do with livestock, but just bought his third rental property? There's a weird contradiction in the world of money that nobody talks about openly. Academics call it the dumb money phenomenon. And right now, it's making average people wealthy while the smart people are stuck waiting for a green light that never turns on. Today, we're breaking down the uncomfortable psychology behind why high intelligence can actually keep you poor, why overthinking is a financial liability, and why the people who skipped econ class are sometimes the ones cashing the biggest checks. By the end of this video, you'll understand the hidden dynamics of wealth that they don't teach in school, and why the smart kids often end up working for the dumb ones. Let's start with a story that proves the system is broken. Part 1. The Dumb Money Paradox. In March of 1929, the New York Times ran a story that seemed almost unbelievable at the time. Two waiters at the Bankers Club in New York had just retired early, not because they saved their tips, because they turned small stock market bets into enough money to buy a restaurant and a farm. The journalist covering the story noted something strange. I'm quoting directly here. The people who know least about the stock market have made the most money out of it in the last few months. Now jump to 1999. Forbes writes about a 25-year-old former waiter from Queens who turned $1,100 into $100,000 in 2 months trading tech stocks. The headline called it Amateur Hour on Wall Street. Fast forward to 2025. The Wall Street Journal profiles a server at the Cheesecake Factory who followed random accounts on YouTube and X, bought Palantir stock, and now manages a 7-figure portfolio. 3 different decades, 3 different waiters, 1 identical pattern. According to the financial establishment, the hedge fund managers, the PhD economists, the certified experts, these people are supposed to be the dumb money. That's the actual term they use for regular investors. And look, the data shows that most retail investors do underperform. They buy high, sell low, and lose money over time. So if that's true, why do these stories keep happening? Why do average people keep winning during major market moves? Because there's a psychological blind spot that intelligent people fall into, and the dumb ones accidentally exploit it. Part 2. The Psychology of Action versus Analysis. There's a concept in psychology called the paradox of choice. The basic idea is simple. The more options you have, the harder it becomes to make a decision. The more information you consume, the more you doubt yourself. The intelligent person wants to read 10 books, analyze 50 charts, and wait for the perfect entry point. They want certainty before they act. But while they're analyzing, the market moves. The opportunity passes. They suffer from what's called analysis paralysis. The less analytical person, they operate differently. They're influenced by something psychologists call the omission bias. The omission bias is the tendency to feel worse about losses that come from actions we took than losses that come from inaction. The intelligent person thinks, if I buy this and it crashes, I'll feel like an idiot. I'll have no one to blame but myself. So, they do nothing. The less analytical person thinks, if I don't buy this and it goes up, I'll regret it forever. I'll kick myself for missing out. So they buy. And here's where it gets interesting. The market is structured to punish overthinking. There's a neurological phenomenon called the curiosity gap. When you see an asset moving up, your brain releases dopamine just from imagining the potential profit. The analytical person tries to suppress that dopamine with logic. They tell themselves it's irrational. But by the time logic catches up, the move is already over. The less analytical person just follows the feeling. And sometimes that's exactly what the moment requires. But there's another layer to this. Because the people who profit from keeping you confused have mastered the psychology of fear. Part 3. The psychology of the experts. Why do we trust financial experts so blindly? There's a well-documented bias called authority bias. We're wired to believe that someone in a suit with a title knows more than we do. If a doctor prescribes medicine, we take it. If a financial commentator on television says the market is dangerous, we sell. But here's what they don't tell you. Many of these experts aren't wealthy from investing. They're wealthy from you watching them. In psychology, there's a concept called mirroring, where someone projects confidence and authority to gain your trust. The news anchor isn't giving you financial advice, they're giving you content. Fear keeps you watching. Uncertainty keeps you glued to the screen. They also exploit something called loss aversion. Research shows that the pain of losing money is psychologically about twice as powerful as the pleasure of gaining it. So, the media bombards you with worst-case scenarios, market crash imminent, recession warning. Experts say, sell now. The intelligent person hears this and gets cautious. They wait. They hesitate. The less analytical person? They're not watching the news. They're watching the actual asset. They're watching what's happening in real time, not what someone on television is predicting. There's also the element of social proof. The intelligent person often prides themselves on thinking independently. They don't want to follow the crowd. But crowds aren't always wrong. The less analytical person sees his friend make money in something, crypto, real estate, a new stock, and instead of dismissing it as a bubble, he asks a simple question. How do I get in on this? That curiosity, that willingness to learn from others, is often more valuable than any advanced degree. Part 4. The mindset divide. So let's break down the actual mindset differences between people who build wealth and people who just look smart on paper. 1. Speed over perfection. The person who builds wealth understands that a decent decision executed immediately is better than a perfect decision executed too late. The intelligent person waits for ideal conditions. But ideal conditions rarely arrive. Perfectionism is just fear dressed up as diligence. 2. Willingness to break rules. The less analytical person doesn't always know what they're supposed to do, so they try things that seem obvious to them, but violate conventional wisdom. The intelligent person knows all the rules, so they stay inside the lines. But wealth is often found outside those lines. 3. Relationship with failure. The intelligent person often sees failure as evidence of incompetence. It's embarrassing. It's something to avoid at all costs. The person who builds wealth sees failure as tuition. They expect to lose sometimes. They know that 90% of startups fail, but the 10% that succeed create most of the wealth. 4. Urgency. This one is uncomfortable to talk about, but it's real. If you don't have a safety net, if you don't have family money or a backup plan, you develop a different kind of motivation. You move because you have to. You take risks because the alternative is worse. That pressure creates action. Part 5. How the system traps smart people. Here's the final piece of the puzzle. The system is designed to keep intelligent people playing a game they can't win. Think about the path that's laid out for you. First, go to school. Get good grades. Then get a good job. Then save 10% in your retirement account. Then wait 40 years. That's the deal. Follow the rules, delay gratification, and eventually you'll be fine. But 40 years of saving 10% in a savings account won't buy a house in most cities anymore. It won't give you financial freedom. By the time most people realize this, they're too deep in the system to change course. Meanwhile, the person who ignored that path, who took risks, who made moves, who didn't wait for permission, has already built something. They understood that the best opportunities don't wait for you to be ready. You have to take them when they appear. Conclusion. I'm not saying intelligence is a disadvantage. I'm saying that intelligence without action is useless. The world doesn't reward the person with the most information. It rewards the person who actually does something with what they know. The people who build wealth play a different game. They play the game of momentum, of action, of psychological awareness. They understand that fear is just information, not a command. So here's the question I want you to sit with. After this video ends, are you waiting for permission? Are you waiting for the perfect moment? Or are you ready to make a move with what you have right now?